Every investment opportunity comes with interesting realities. In every project that involves money, there will always be risks on one hand and benefits on the other. Being smart begins with getting the right knowledge, and useful knowledge only comes from information. Investing in the stock market, just like every other venture, is both exciting and challenging. If you are new to investing and you intend to invest in the stock market, there are important things you must know even before you start. The amount of information you have will determine how much success you will generate. I can tell you, no one takes prisoners in this jungle. The two factors that will determine your success in any investment venture are 1. Risk, and 2. Reward. Your goal should always be to reduce the risk and increase your reward. But before you can do this, you must know what the risks are and also what the rewards are. Then, you should think of what you can do to bend situations in your favor. The risk factor presents you with the possibility that you may lose your money. Losing money is one song that no new investor wants to listen to. The sound of it will send chills down your spine. But if you understand the dangers and how to manage them, then you will be open to receive the benefits. We shall look at the stock market from a general point of view. We shall also take a journey from where it all started down to where we are now. I can assure you this is one ride you wouldn't want to miss before putting down your money on any stock. Does this sound valuable to you? If it does, just do this right now. Go ahead and hit the like button and also subscribe so you'll be able to get more videos like this. Done? Great. Let's keep going. What is the stock market? Credit to Investopedia.com. The stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. These financial activities are performed through official exchanges or over-the-counter marketplaces. The transactions must operate under a defined set of regulations. A country can have multiple stock trading venues. At these venues, transactions in stocks and other forms of security can take place. As long as all the parties involved play by the rules, they are good to go. Definition of some important terms: stock market and stock exchange. The terms stock market and stock exchange are often used interchangeably, but in fact, a stock exchange is an offshoot of a stock market. Please don't find these expressions confusing. I will explain them easily. Many make this hard to understand, like it's rocket science, but it's not. Let's pretend that we know a certain Miss Veronica, who's an investment enthusiast. If she tells us that she trades in the stock market, what it means is that she buys shares and equity on one or more exchanges. These exchanges make up an entire stock market. The leading stock exchanges in the US are the New York Stock Exchange, NYSE, NASDAQ, and the Chicago Board Options Exchange, CBOE. Many other exchanges are operating in the US, along with the above three. Together, they form the US stock market. Beyond the US, there are various stock exchanges in different countries, such as Japan Exchange Group, Japan, Shanghai Stock Exchange, China, LSE Group, UK, Shenzhen Stock Exchange, China, and BSE India Limited, India. There are a whole lot of them spread across many nations of the world. Simply put, stock markets are public venues where people come together to buy and sell shares. But advancement in technology has made it possible for these exchanges to exist as electronic marketplaces as of today. Stocks or shares. A stock or share is a financial instrument that represents an ownership stake in a company. Ownership of stock in a firm gives the shareholder the right to receive a residual income from the company's earnings. These payments are made quarterly, biannually, or yearly, and are called dividends. Stock ownership often gives the holder the voting right during the firm's corporate meetings. If you own stock in a company, it means that you're entitled to a portion of that company. Should the firm decide to break up today, what you will receive in the form of cash or assets will be directly proportional to the percentage you own in that company. Let's pretend you invested in a company that has total outstanding shares of 2 million. If the number of shares you own is 200,000, what it means is that you own a 10% stake in that company. Note that there are corporations whose outstanding shares run into the billions. Brief history of the stock market. The stock market has not always been structured, organized, and regulated as we have it today. It has taken centuries of growth and advancement to get the market to this point. The 16th and 17th centuries marked the emergence of the first stock markets in Europe. Trading started in the port cities of Antwerp, Amsterdam, and London. These early centers were into bond exchanges. The companies involved were few, and they would not issue equity. The 18th century marked the start of the American stock market. The first stock exchange that sprang up is the Philadelphia Stock Exchange, PHLX. When the New York Stock Exchange, NYSE, was founded in 1792, it allowed for equity shares to trade. 24 New York City stockbrokers and merchants came together to sign what is known as the Buttonwood Agreement. Before now, traders and brokers met under a buttonwood tree on Wall Street to buy and sell shares. These prior meetings and transactions were not official and were not properly regulated. Further advancement into civilization brought about regulation and professionalism in the share market. Many stock exchanges eventually developed in the US and throughout the world. Today, technology has even gone further to shift trading from these centers to the internet. Some of the exchanges are electronically linked, and traders can be in their homes and buy and sell in an organized structure. While there used to be an insider's advantage, the stock market today has grown to become more efficient and more liquid. There is a level playing ground for every participant, for the most part at least. Supply and demand in the stock market. There are so many ways that the prices of shares on a stock market are set, but the auctioning process seems to be the most common. In this process, those who buy and those who sell place bids and offers. Bid. This means the price at which an individual wishes to buy the stock. Offer. This is the price at which a person wishes to sell. This is also known as ask. The person bidding and the person asking have to agree to price for a trade to take place. Fluctuations in share prices happen because there are thousands of negotiations going on at the same time. The function of a stock exchange is to provide the platform that connects these individuals who want to sell and the investors who want to buy. If you intend to have access to these exchanges, you will need the services of a broker. The broker is the middleman who stands between the guy that's selling and the guy that's buying. Interestingly, the brokerage has moved from registering with individual brokers in their offices to creating an account with an online retail broker. The law of demand and supply has been a major factor in every economic setup. It's even more obvious in a system that involves millions of people transacting at the same time. Now, here's how the law of demand and supply works in real-time stock trading. When there are more investors showing interest in the stocks of a particular company, the price of that stock will go up. On the other hand, when more holders want to sell the stock of a company, the price goes down. We've seen earlier that a trade can only happen if a buyer accepts the price the seller is asking for, or if a seller accepts the price a buyer is bidding for. Now, when the buyers outnumber the sellers, what happens? The buyers will be willing to raise their bidding price. Look at it the other way. When the sellers outnumber the buyers will lower their bids. Then, the sellers will be willing to take lower offers. So, the price of a stock responds to the laws of supply and demand. The don'ts of stock investing. 1. Don't be emotionally attached. You must avoid investing in a company because you have a special liking for that company. I once heard the story of a retired soccer player. Let's call him Mr. John. John grew up playing for his home city's local club. His skills were groomed at this club. With the club, he won many local and regional awards. His best childhood memories were birthed in this club. Later on, bigger clubs noticed his talent and signed him. He eventually became a big player and an international star. The money was coming, and he retired with so much wealth. Upon retirement, his first investment move was to acquire his childhood club. He neither looked through the records properly, nor did he get the services of an investment advisor. He put most of his savings into buying this club because he was attached to it. What happened next? He lost his money. He didn't know the club was neck-deep in debt. He had acquired a liability instead of an asset, so he found himself in a financial mess. John committed this blunder because of his emotional attachment to his childhood club. Many people commit this kind of blunder while investing in the stock market. Some people buy the stocks of a company simply because they like it, or because of the past exciting stories they heard about the firm. This can be dangerous. Another problem could be selling too early because of excitement, or selling when little fluctuations come up. Just leave your emotions at the door if you want to play this game. 2. Don't invest randomly. Buying the shares of a random company is the same thing as gambling. This is what some people do, as ridiculous as it sounds. They just do it, to feel like they're investing, but they're actually playing with their money. You should invest in a company that has a track record of measurable progress. You must do a background check on the management and their indoor practices. The management in some companies cut corners and may have a long line of legal battles. These folks could be dishonest and may have cornered some profits to themselves. leaving the company vulnerable. They may have hidden most of the risks from investors. Investing in such a company means you're gambling away a fortune. Before buying the stock of any company, make sure you understand their records and their history. Be convinced of the capacity of the firm to grow its value over time. Remember, you're investing to grow your money and not to lose it. What you should do to get the best reward from your stock investment. 1. Diversify your investment. You should spread your investment across the different levels of the stock market. There are large, medium, and small level listed companies. You have to take this step only after you've done proper research on each of the companies you'd like to invest in. This will help you combat the fluctuations in the market. Some shares will do well, while others may not do so well. But diversifying your portfolio will give you enough backup to know that at least your investments will be on a steady rise, no matter what happens. You've probably heard the saying, don't put all your eggs in one basket. 2. Invest for the long term. Investing for the long term means you're prepared to hold your shares for upwards of 10 years or more. If you're in a hurry for profits, you might fall into the trap of elements. These two emotions cause people to lose money in stock investing and other forms of investing. The emotions of fear and greed have been identified as the greatest cause of money loss in investing. A fearful person wants to sell as soon as their stock starts going down. A greedy person wants to buy when the stocks are appreciating. Stocks fluctuate constantly. The indexes go up and down. But if you've made the right pick, your money will be safe in the long run. A long-term investment will yield outstanding results, no matter the number of fluctuations that happen along the line. If you enjoyed the free value you got from watching this video, you can get more. Here are some videos you can watch. When is the right time to sell? How to be a good investor. 7 new rules of money for 2021. So thank you guys so much for watching. If you found value in the video, give it a thumbs up. And if you're new to the channel, welcome and subscribe for more videos like this. With that said, have a great day you guys, and see you in the next one.